What's good? It's time to go. So today's the day. We're gonna get this meeting started here. Probably, I think they're going in about 30 minutes or so. But today's the day. We're gonna find out if these interest rates are gonna go up. So we'll see what that looks like. I'm excited to kind of watch this because we're kind of getting to that point, especially with the market, where people are like, "Come on, we just need something to give. We need some type of whether it's hopium, some type of clear course of direction on what this market is going to do." I think there's going to be a big meeting here because, I have my expectation of what I think. I'm excited to see what you guys think as well. But yeah, nonetheless, I want to show you guys some things that I'm actually looking at before we start the meeting because I really think this is going to be really big to watch. The biggest thing that I've been trying to do with the channel over the last month or so is really just trying to help everyone understand the correlation between traditional equities, bonds, and then also crypto. So all of these things are married together. And then so when we see things shake and move, especially within these other asset classes, it does have an effect on crypto. So really quickly, I want to give you guys a quick little update as far as earnings. So the last stream that I did, I talked about earnings and how it's going to be a big week. And so far we had some, a little bit of news, but it's a little bit I would say just expected, right? So Walmart, they came out with a projection saying that they're going to have declining sales going into Q3 and Q4, and so that's actually pretty interesting because the everyday person, I would say, people, especially like on the lower income part of the spectrum, they shop at Walmart, and then so this is really kind of for like we're getting a good foresight of how things are contracting for the everyday person, just with that there. And so a couple other companies here that we had. So Alphabet and Microsoft, they kind of had a beat on their earnings, and so they had very optimistic reports for Q3 and Q4, which actually helped the futures markets get a little bit of a rally here. And so that's what we're kind of seeing. There's not like a big dumpage all across all equity and stuff like that. And so things are kind of steady, and we actually seen Bitcoin kind of prop back up today. And so traditionally, what we've been seeing is a heavy dump into the meeting. And after some meetings, we've actually seen a rally. So this is going to be interesting. We're at an interesting spot, where we're kind of seeing some things, like I said, just really starting to solve themselves out. And a big thing I want to talk about when it comes to bottoms or recessions or whatever you want to call it, we're all probably looking at this from an investor standpoint. But the biggest thing I want to say is a recession is not like a point, or a bottom is not like a point. It's a process, right? So it is a process of things getting figured out, especially economically, as what we're seeing. But then as far as markets go, things getting figured out as so far as people are saying, okay, hey, here's where we say, risk on, for example. So we know Bitcoin is risk on, and it's very much seen like the tech sector when it comes to equities. When people kind of look at this, say, okay, we're ready to go risk on again. And you got to think about these large entities, these industrial type, I would say, these companies that are just looking to disperse capital, right? I'll say that they have a job of risk mitigation. And so the thing is, Bitcoin and crypto being something that's a little bit more on the speculative side of things for them, they're going to look at things and say, okay, well, what's the risk here? And so right now, risk is pretty high. And then so we need to see that peter away. We need to see inflation come down. A lot of things happen. We need to see hopefully the supply chain open back up, be a little bit more, giving in a sense, especially here in the United States. But we know a lot of countries are going through it right now. China being one of them. I know people aren't really talking too much about China. People think things are all great in China. Things aren't so great over there. Europe obviously going through a hard situation and stuff like that. So I want to start off with that before we get into it. But let's address everybody in the chat. So yeah, I'm curious to see what you guys think. What do you guys think? And I see a couple of things. Some people think that we're going to have 125 basis points. There's 75 points on the table. But really quickly, let's address the folks in the chat. KK, hey, thanks for reaching out. I really appreciate that. We're going to continue to make these streams even better. So I appreciate your input. Nice to see you. Let's see here. Who else we got? Hey, that could be something if they slap 200 basis points, which I don't think that's something that they'll realistically do, but you never know. I've seen crazy things happen within markets, and so, but traditionally they try to say they're conservative, but the Fed may do some crazy things here, to try to spark things up. But we'll see. What's going on, Juice? Nice to see you. Nice to see you. Let's see. Oh, and we cannot forget, this is what it's all about. BFD gang. I'm glad that we kind of corralled about like for me, my thing is like, hey, let the people decide. So BFD gang is what it's going to be. Let's corral around it. I'm with it. Let's see. Cool. All right. So as we get started, I'm going to dive into some things here. And I'm going to start off with what we can expect for this Fed rate hike. But then as time goes on, I'm going to kind of go back and forth, try to check and see if they're starting here for this Fed meeting, which hasn't started yet. But yeah, it's going to be an exciting day. So let's get into it. So let me share my screen really quick and get going. All right. So, just like a small recap of what we were talking about in the last stream, and it's pretty cool because here at the CME group, they have a nice little countdown, right? So we got about 18 minutes before this meeting starts. But here we go. So the target rate probabilities, and so this is as of today. So we can track this daily, we can track this weekly and monthly, and there's so these algorithms that the CME group they use to get a real sentiment on the probability of what things may be looking like. And so the current target rate where we are now for the Fed's fund rate is 150 to 175 basis points. So where are we looking at pricing things in? I would say the market has priced in about 75 basis points to date. Anything more than that may be a shock to markets to the downside, and so that'll be interesting. But as you guys can see, this has kind of gone down a little bit. So through the past 3 or 4 days, we've seen this at about like 79%, 76%. As of today, the meeting date, we are at 73.9%, which is, that's still pretty convincing. And so a full basis point, which is, what this is showing here, this kind of crept up, right? So this was about 22% earlier this week. So now it's sitting at about, 26%. So that's pretty interesting because there's a 1 in 4 chance that we might get 100 basis points. I don't think it's been this high in quite some time. Now, since we do know that we do not have a meeting coming up in August, so they're skipping August as far as doing any interest rate hikes. I think that'll be I think that'll be an inflection point because it allowed them to maybe take a little bit more data in. So they're not making these decisions every single month. They have an extra month to take the data in, see what's shaking and moving. And that's going to be, I think, in my opinion, a big spur of saying, hey, there might be opportunity for things to start to turn around. That's just my personal, I say, evaluation. But, nonetheless, the debt cycle has not improved. Like we can see it all across the board. The debt cycle has not improved. The credit cycle is still in dire perils right now. So we're going to keep an eye on that. But let's take a look and see, well, what is the market thinking as far as September? And so here is very interesting because you see a little bit more disbursement between options. And then so there's not one that is overwhelmingly more than the others. Like, for example, this is overwhelmingly more than this option here. So 75 basis points compared to, one whole percentage gain for the Fed funds rate. Now here, when we go to September, we see more options first and foremost, but these are pretty even. So this is 50 basis points, 75 basis points, and then people aren't really seeing 100 basis points coming along in September. And so I think this is actually a good sign. I think this is a sign of saying, okay, things may be, getting better on this front where they may slow it down. I'm not saying that they're going to stop raising. I'm saying that they may start to slow it down. And there's also some credence, if you guys remember some of the charts that I was showing in terms of the 2-year bond yield and how it has a good, it does a good job of basically setting a cap to the Fed fund rate through time. And we're looking at this through a span of not just in the past 2 or 5 years, 20 to 30 years. And so, and that 2-year bond yield is sitting right about 3%. And so we'll see if we can get to 3%. And that's kind of what's on the table for now. But I did want to stop here and take a look at see what is the probability going on for today's meeting. So really quickly, I do want to talk about some things involving the VIX. So I know we talked about the PCC quite a bit. We talked about that last week. We talked about the VIX as well. So let me kind of zoom out and give you guys the full rundown on how I've been using the VIX to really help me out to understand the high volatility time periods. And so, really, if you guys haven't seen this chart before, let me see if I can give you a quick orientation of what this is. And so, essentially, this is the VIX for the S&P 500. So, this is testing and showing the volatility in the stock market, essentially, because the S&P 500 is a great representation of the core of what stocks are doing in the United States here. And so typically when the VIX spikes, that means there's volatility. And volatility mainly comes when market and prices are going down. And then so there's an interesting thing that we're kind of experiencing that is pretty unique, right? And so as you can see in recent times, so if you really want to take a batch look, especially since COVID, but really since like 2021, and then really start to accelerate in 2022, just look at the cluster, right? And we're seeing, and let me clean that up just a little bit. We're seeing the VIX on average being pretty high compared to recent years and recent time. And we can see that all across the board. We're seeing, Netflix going down, 40% a day, Snapchat going down, like all of these tech sector companies, right? And even other sectors, there's a lot more volatility in the market compared to recent time. And then so, but one thing that we can really see is when the VIX spikes and has like this outlier event, this is synonymous with finding lows in the market. So if I were to, pop up, let's see here if I can pop up the SPX. So let's do that. And what we've seen here, and so let's get that in frame. Let's see here. So yeah, let's get that in frame. And then so what you are able to kind of witness here is when you kind of see these spikes. So for example, we'll go all the way back. We can go all the way back to 2008 really. When you see these spikes, typically that shows a relative low. 2008, there was like a afterburner effect of, trickle down as far as, companies still suffering. But traditionally what you see is a local low as far as markets go, especially the SP 500. And so we know that in the NASDAQ has a lot of correlation with the crypto market. So as you can see right here, when we have this high spike on the VIX right here, you see, this is showing, okay, volatility is ramping up. So that means prices are going down, obviously. And you can kind of see that double peak here. And then once again here, we can actually put another vertical line here. And so you see how that is synonymous with a local low for that time period, right? And then so same thing here. You can go back to here May of 2010, a local low. Here again, where VIX is, trailing higher, right? You see a low in the market here, and it's all about rate of change, right? So rate of change basically seeing, okay, I would say this is normal, like normal rate of change, just back and forth. There's these spikes, but that outlier where the rate of change goes from drastic, from a low to a pretty high here. So that's what I mean by rate of change. It's something that is a little bit of an outlier at an accelerated pace compared to the normal trend of, whatever the metric is doing. And then so kind of we want to continue to stroll forward here. That rate of change from the VIX going to very low volatility and it's spiking up to here, right? There's a local low here, once again, right here. And then so things really get interesting because here, let's do that. So, because this thing has been really helpful. I'm not going to say this is a perfect indicator, but it's been helpful. It's all about trying to get a lot of data from many different sources and saying, okay, how does this all correlate together to help me make my financial decisions? And obviously, as you guys know, it's not financial advice. I'm just here to be a PA system, a conduit of information to help us all kind of evaluate things and really try to manage things through a very tough time within markets. And this is obviously a bear market. And then so same thing here. I mean, if we look at, the most two recent times, right? So we have December 18 of 2018. We see that outlier event where the VIX really pops up. And, and so a key area, which I'll say is, and I'll put a line here that is going to go horizontally when the VIX is, consistently over 30, right? Or pops above 30. These are areas where we want to kind of say, okay, there's probably going to be some local lows here. And so I'm going to dive in a little bit closer to get a little bit more detail with that explanation of why I say 30 is the point to where we want to be paying attention to on the VIX. And so let's kind of change that color. We're going to make that yellow, and then we're going to turn this. There we go. And then so, right here with COVID as well, we've seen that really spike up with a lot of volatility. I mean, we got over 50, which is a pretty rare scenario, right? And as you can see, that was a local low here in price. And so I do want to dive in a little deeper here because there's some things that we're noticing, well, that I'm noticing as far as trend goes when it involves the VIX and price action as far as the market goes. And then so if you guys can kind of track with me, and I'll do my best to explain this. Sometimes I can see it for myself, but let me see if I can explain this to you guys here. And so let me just try to line this up to where it makes sense. All right, cool. And so the interesting thing is, as we can see, right? So this is an overlay of the S&P 500 and the VIX here. And then so typically, like I say, when we really start to ramp up, that rate of change with the VIX starts to ramp up. And what I'll do actually, what I have it on is the Heikin-Ashi candle. So if we kind of zoom in here, we can see these are Heikin-Ashi candles. So these do a real good job of establishing and really helping us see what trend looks like versus the regular candles. And so as we go here, we have the top of the market. And what do we see? We see the VIX start to rise pretty heftily, right? It tops out. And then so, mind you, these are points above 30 where it starts to top out and lose steam, okay? And then what do we see? We see a dramatic downtrend in price. Now, when we top out and we go down with the VIX, what do we see? We see our relief rally. We see the rebound. Now, going back here, we see that acceleration with the VIX, right? What do we see? Price going down. And then vice versa, the VIX coming back down very heftily. What do we see? Relief rally. And then so that relief rally comes through. And then same thing, we see the VIX kind of accelerate, going back up. So basically, when we see volatility going up, expect prices to go down. And this is a theme that we're gonna continue to see because this is just how markets move, right? And then so same thing here, VIX going up, dramatic price going down, right? And then so we have that rebound with VIX coming back down, okay? And then so VIX coming up, right? And this was this capitulation here. So let's line that up. So VIX going up again. Then we have the capitulation coming down once again. And then same thing here. Now this VIX has been trickling down. And what do we see? Another recovery. And so as we can see, I kind of have this trend line here because we've seen that the volatility on average, right? On average is getting higher through time. Now we'll see if this starts to break, but this is why I have the Heikin-Ashi candles on. So we can take the S&P 500 off for now and kind of dive in a little bit deeper here. And then so the Heikin-Ashi candles do a really good job of helping us see trend. And so we can see when we have these wicks at the top, right? That's clear that these green candles is we're on an uptrend with the volatility. Same thing, wicks at the bottom with the red candles going down. And then so we've been kind of back and forth, back and forth, back and forth. And if you were to inverse this is exactly what a lot of these prices for these assets look like. Uptrend, then it kind of had a pullback, uptrend, pullback, uptrend. Now the question is, are we going to see another spike? Because when we see these spikes with the VIX, what do we notice? It's not necessarily like this back and forth. What do we see? We see these large, just continuous dumps, essentially. So volatility going high, right, at a quick and fast pace. And then so if we were to put this on the daily chart, so this is like, okay, weeks at a time where it's just like, okay, a week and a half, just price is going down, right? Same thing here, price is going down, price is going down, price is going down. And then so this is really, like I said, really accelerated, to where the average is starting to stay above 30 for more considerable time. Because if you look at subsequent years prior, really didn't get above there and sustain it like how we are now. Like I said, that rate of change, right, is pretty interesting here in recent time. And so this is like the inflection point is, okay, maybe, this trend line gets invalidated. So trend lines are nothing but lines. They can be invalidated just like how a lot of metrics can be invalidated all the time. And then so, but these are pivot points to just make note of. And so if we see this get breached and broken and coming down, and maybe we start to see that VIX start to tread down to this level of maybe like 20, 25, somewhere in there. Oh, so we're already at 25, but we kind of see it come down to 20. That may be a sign of, hey, continued rally. And then so that's something that that I'm going to keep my eye out on. But if we were to keep this trend line, or just something that is normal within kind of what we've been seeing, we may see a little bit more rally, and then we see another leg down where the VIX and the volatility spikes up, right? And then that means asset prices will come down. So we know out of all the asset prices, crypto is the most volatile. So there's going to be large price reductions. So for people who are looking to accumulate, great opportunity. But learning how to pick your spots, I think is a value to doing that. Now, I know in the grand scheme of things, 5 to 7 years from now, probably not going to be too worried about, okay, me buying, Ethereum at 1,500 versus 1,000 may not make that big of a difference 5, 7 years from now. If you have that long time preference, which I would encourage everybody. And like I said, this is not in financial advice. I'm not qualified to tell you what to do, but I can tell you what has worked for me as an investor for quite a long time, and really basically stretching out your time preference, right? And so not going based upon like a 6 month or a 1 month or even a 2 year scale, really allowing time to play out. And so, I want to kind of come back with the VIX and kind of show you guys kind of what I'm seeing here. And so we'll see if we can get a continuation of trend, meaning there's a rally in the market, or we kind of turn around and we see things kind of spike back up. So, that's that. Really quickly, let's go back to the chat and see what you guys got going on over there. Hopefully y'all are liking this information thus far, and it's helpful, to what we're talking about here. So let's see here. Let's see. I see it. I mean, hey, you know what? It is what it is. I know what I'm investing in, right? I know where, I have confidence. It's because I've done the research, right? And so, you're going to see some heck stuff on this channel without a doubt. Let's see here. Just heard on the radio that the expectation is 75. Yeah, so we just went over that. I'm probably expecting that as well. 75 is what is in line, and kind of the tone that they've kind of been using thus far. Doom. Hey, say no more. Say no more. We know what's up. We know what's up. Right. Cool. Well, with that being said, let me do some work here on the back end. Let's see if they got some things up on the Federal Reserve site, because I want to watch this thing live with y'all. And so we may have a little bit more time. So they actually, I think they're pushing it back here a little bit, 2:30 Eastern. And so we got a little bit of time here, actually. So I probably got about another 30 minutes. We can dive into some stuff. I'm always open to, anything that y'all want to talk about. And I have some things that I'm kind of looking at. But as we can see, if we go check Bitcoin right now, we kind of see a little bit of a rally of what we're seeing, especially from this morning. So that's something to look out for. So let's get back into it, and then let's go ahead and take a look at Bitcoin for the moment. All right, so BTC, what do you got to say today? All right. Oh, guys, really quickly, if you guys have not, please, if you can, I would really appreciate it. Smash the like button, hit the subscribe button. If you guys have any friends, any family members, tell your wife, tell your wife's boyfriend, tell your girlfriend's boyfriend, come through, right? Give a subscribe. I really appreciate it as we kind of share this information and, really try to do justice out here, because, there's a lot of just people out here. Hey, buy this, buy that, do this, do that. I'm not trying to tell you guys what to do. I'm just here to present the information with the contrarian view compared to what a lot of people do here on YouTube, to be honest. And I'm going to just be as real as possible. I know what I'm doing. I encourage everybody to have a plan and try to execute on that plan. One thing I know about myself is execution is a big part of the battle. It's the mindset first, being able to create that plan, but then executing that plan. But the thing is, if you don't have a plan, then that's on you. So yes, it's crazy because we are seeing a little bit of a pump. Let me kind of get this thing straight for us. Okay, so we've been in this parallel channel, and we kind of broke out, and got a lot of people long. This is why leverage is a little dangerous, because you get long and then things kind of turn around on you. And then so typically what we've been seeing going into the meeting, right? So for example, the last meeting was on the 15th of June. And so we typically see a dump into the meeting. And so we kind of seen a smaller version of that here. So we had this uptrend and we had a reversal here, but now things are back on the hunt. So I really like using these parallel channels because it really helps us understand the line of demarcation, right? And so that midline, this dotted red line, is very helpful. So a lot of time you see price do its decision point here in many different ways. And so, for those that have been watching the channel, you've seen me use these parallel channels to the benefit of our knowledge, because we see a lot of price swings either crush through it or things get decided here, right? And so what I want to do is kind of dive in. So what we can do is a couple different things, right? We can look at it from the typical technical analysis standpoint of just basics, and then we can dive into some unique ways that I've been kind of using to evaluate things. But we can go with the basics now, and go from there. So we can do a fib retracement. So this move here, so we take the bottom of that wick to the top. And then so the interesting thing is we wick down to the golden ratio here. And then so I have that in gold, that 0.618 area. And this is what a healthy pullback looks like. And this is, mind you guys, this is extremely, extremely short term. Like we're legitimately only looking at the past couple months of price action. And then so just understanding when we look this zoomed in, there's certain topics that are going to be talked about versus the overall look, right? So the overall look is where we at in a bear market. So keep that context in mind as I kind of go through that, because that's an incredible thing to think about and understand, because of wow, this thing is pumping. We may see 22K here in a few seconds, but it's an incredible thing to understand, because it helps you understand, okay, well, what portion of capital am I looking to allocate, or you just kind of saying, okay, well, let me just nibble at the market. All these things matter in context, right? So with that being said, we came back down and we popped up here, and we're kind of attacking back to this 382. And so what I'll do is I'll put this volume profile on. And so what we can see here on the left side of the screen is especially the reason why I'm thinking that we're settling down here pretty well is because if you look at the past really couple months, there's a lot of volume. So basically a lot of people that have come in this market and BTC have exchanged hands in this area, and hence why, we're having a nice little support here, but nonetheless, people expecting some great things coming. And so I think the markets are saying, hey, we priced this thing in right, and we're seeing a little bit of a rebound rally here. And so that's with Apple and I believe Amazon. They have their earnings report coming up here tomorrow. And so, there's a lot of things going on right now, but that volume profile is a good, helpful resource for us to see where that support is. Okay. Now from there, if we want to kind of look at some Bollinger Band uh, stuff here and this line here. So typically, this Bollinger Band, this is kind of telling you, okay, when are we overvalued? So when we're kind of pressing up towards the top, and when are we starting to get oversold? So will we come and we tap or touch the bottom of these Bollinger Bands here? And so the interesting thing is, we kind of use this middle trend line here. So this is the 20-day moving average, and we straddle below it briefly, but we're looking to get on top. What we can actually do is pop this on the 8-hour really quickly, and this is going to show us a different view. So understanding how the different day time frame. So whether you're looking at the 1 day, the 3 day, the week, or the 8-hour, the different time frames, these moving averages change. So now that we have this moving average here, now this is why we have resistance, right? And so the key level, if we want to stay bullish, right, this level here is actually going to be something to really pay attention to. So if we can solidify and get above, so I'll put a price call here. If we can solidify and get above 22,200, that, and we kind of maybe even come above and use that support, that may be a great thing to see as far as positive price action moving forward. And so this is a plus. Seeing this little bit of rally, that's very inspiring to see. And so outside of this, right, like I said, now coming off of this Bollinger Band, we're in no man's land. And so legitimately over the next 16 hours, so 2 candles, we're gonna really see which way this thing may be going. And so we continue. So when we could bring this volume profile back up, and if we continue to get above this point here, right? And so if you can kind of see where we're at, we've really done a good job of popping up above 21K, 21.5. And so, and this is just going off of the first initial capitulation. So let me kind of dive into what I mean here. And so what we see here is a wedge, right? And we have this first capitulation, right? And then so we come off of this capitulation, the market decides how much they want to rebound. And then so this first point here is kind of like, okay, this is what's going to set the tone for the rest of this month, essentially, right? Or time after this, right? And then so we see markets kind of fluctuate. And like I said, this median line does a good job of letting us know where things happen, right? Somewhere around here. But we've gone above this 21.5 level. We wicked above it here. We got above it here pretty strongly, right? And then we kind of outpace this quite often. So we've had 3 occurrences where, this capitulation starts. And this is like really dissecting the ebbs and flows of market pricing, right? And, so we can kind of see a straddling back and forth in this channel. We kind of deviated out of it, right? But nonetheless, we've done a pretty good job of really coming back to this 21.5 level here, and really kind of pressing above it. And so, like I said, coming up here, we really want to see if we can get above this 22,000 and some change, and that's going to be nice to see. So if we kind of go back to the daily chart, right? So we'll start with the daily. We're going to see things in terms of RSI and MACD. So let's kind of look at the MACD. And so you can kind of see how we had a nice pump coming out of, mid-June. And so as y'all can see, we had a nice little pump to the upside, which, that was nice to see. But that pump obviously has started to simmer down here over the past 3 or 4 days. And then so we're going to see, because oftentimes we see a flip. So going from green, so obviously things going up, to red. And so what you'll see is these moving averages also flip and start to come and trend downward. And so we'll see, right, over time if that happens. But a lot of times you see a continuation where you think, okay, you know what, things dying down, and you see liquidity and a lot of sentiment change, right? And then liquidity comes back to the market, and we start to see more green candles here. So we'll see if that's the case. But nonetheless, as you can see, obviously we spent much more time on the bottom portion, right? So the bottom portion, especially looking at these moving averages here. So we've spent a lot of time below, right, the midline of 0, right? So here, right, and since the beginning of the year, especially, right, we spent a lot of time kind of coming down here, and we spent very minimal time on the uptrend side. So we've had our little relief rallies, right? But this is how you can tell and understand the difference between a bear market and a bull market. You see much more bearishness going on, and using these moving averages right above the midline really help you understand the big macro picture amongst some of the smaller things that may be going on in the short-term price action. And so, that's always helpful to kind of look at the MACD and realize big picture first and foremost. So now from here, there's some other things that we can kind of look at here. So we've looked at a couple things. I'm gonna pop on a couple other moving averages to kind of help us get another idea of kind of how we can see things. So we'll pop on the 21-day EMA, which is very close to the Bollinger Band, and let's do a couple more here. We're gonna do the 8. 60. Actually, we'll go 250 for this one here. All right. So let's get these colors right. All right, cool, cool, cool. I like showing a lot of this back end stuff, guys, because I know sometimes for those that are trying to learn how to use TradingView, I think it's pretty helpful to learn how to do this back end stuff. So how to change colors, how to change, line thickness and all that kind of stuff. So, it's a little bit different than other channels, but I like taking that time to go through it. Okay, so with that being said, are my numbers off? They are. This is supposed to be 60. All right, and then we got the 8. Cool. So let's kind of thicken that line up a little bit so we can see it. All right. So back on the daily chart, and the 60 is a really good moving average that I really enjoy using because same thing here, it really serves as a good point of decision time when it comes to Bitcoin in particular, but even all across different markets and stuff like that, as far as stocks and even other asset classes. So we'll get this line here out the way, but it does a good job of kind of helping us understand, okay, well, what's going on? Where is some resistance? And then so as you can see, we've got knocked down by it recently here back when we were trying to push above 24K. Now, the reason why I like using the 8 because it is a quick moving average. So quick moving average, right? Uh, but anyways, right? This really helps us kind of dissect things on the shorter time frames pretty well. And then so I like it because a lot of the time when we could legitimately, so what we'll even do is kind of zoom in here a little bit. A lot of times, right, when we can get above this 8 moving average, so this 8-day moving average, that's going to give a little bit more credence to us kind of continuing, right? And especially if we are to eclipse this the 60-day moving average, that'll really give us a good idea of saying, hey, we might have a sustained rally. Now, where that has a inverse effect, right, is if we get knocked down by this 8 first and foremost, right, then we're not even going to get a chance to get up to the 60. And so that's going to give us credence to understanding that, yes, so price is going to revert back to the opposite side of being pretty bearish after a rally. That is what normally happens. And so, this is going to be interesting to see through time. Now, let's kind of pop down on a shorter time frame here, right? And then so vice versa, right? On this 8-hour in the immediate time frame, we see this 8. And so we kind of just eclipse it. And this is legitimately today. And then so like I said, we do want to sustain that. And then so that's why learning the different time frames is helpful. So you can look at things from different angles, right? But if we come down to the 8-hour, so just immediate time frame, it's looking, so same thing here. If we were to look at this MACD, it looks different compared to the daily. Basically meaning on the shorter time frame, it's looking that we are starting to head into something a little bit more positive. And so, that's going to be pretty interesting to see, is because it may say, okay, we may have a little sustained rally here in the short term. And so we're talking about, like I said, extremely zoomed in time periods, right? We're on the hourly and the daily chart. And typically, if you want a big macro look, we'll be looking at the weekly chart. But I do want to do a little bit of a different view here. And then so same thing, right? If we even just do that same fib retracement, we came down and we straddled this golden ratio. And then where we're struggling against this 382. And this also is as a point where the volume is, right? But then also where this recent high is as well, of where we had a wick here, and then price was kind of settling here from the top, not this most recent one, but from this here. And then so really pushing above this area here, if we could sustain that, that could mean some good price action coming up here in the short term. And so, that's going to be pretty interesting to see. And then same thing, if we were to pop a RSI on here, let's do that as well. So let's pop RSI on and then kind of see what's going on with the relative strength. And so same thing, we're kind of pivoting with the relative strength, going from, okay, things being overheated, right? And then so if you're a swing trader, right, using these metrics are very helpful, understanding trend, right? So if you kind of get overheated, probably want to take some profits, not financial advice. And this is kind of how, me personally, I'm utilizing the skill set, being able to look at these charts pretty objectively and understand some of the sentiment and the timeline of things happening, right? So FOMC meetings, stuff like that, to really gauge the market and kind of how they're flowing. So for me personally, I had some buy orders for BTC at about like 19K. So I was happy that those hit. And also for Ethereum, I was able to get some buy orders under 1,000. And then so now we're, like I said, we're kind of back to this midline here. And so that's kind of what we're looking at. And then so for things to kind of shift and go negative, right? Same thing here. I'll put a line here and say, okay, well, things may be looking bearish if we come back down in subsequent hours or days and we come below this range here at about 20,700. So we'll put a price call here. So these are the two levels that we're kind of looking at. And so until then, we're kind of in no man's land for this thing to declare. So let's do some more. So we got the algo. So shout out to Charlie, Cultivate Crypto. Definitely suggest that you guys go over and get the algo because it's very helpful as well. And so we don't want to only survive and thrive off of an algo. That's why we did all of that technical analysis first, but then we use these secondary factors. So we want to use our human experience. We want to use our human skill set and then allow the computers to aid us and don't just rely on that. But let's see if we have anything kind of popping up here. And so we had a buy signal, and then we did also have a confirmation today earlier. And then so you see that diamond kind of sitting there as well. And so the algo is saying, hey, we might have some pump here coming up. So, that is just the information presented to you. Do with that what you want. And that was like a quick in-depth look at BTC here for the moment. But nonetheless, like I always say, zoom out to really get the big picture, right? So get the big picture, and this downtrend is still intact. So and still until we start seeing things eclipse this trend line here, like we need to eclipse this trend line here heftily. I'm not really seeing too much of a bull mode. And then so same thing here of why I like using this 250. So a lot of people use the 200 week moving average, which is great. I like using the 250 because to me it does a pretty good job of getting those outlier events. So for example, the 200 would have been kind of, I guess you can say kind of coming along here, so at the bottom of here, right? Or matter of fact, let me just put it up so y'all can see what I'm talking about instead of. So let's go ahead and do this. So do the 200. So the 200 week did a good job of catching this bear market low here. Did a good job of getting the candle bodies here, but nonetheless, we've seen this 250 also come into play as well. And then so what we can see here is we had some wicks kind of right to it, and and I did a lot of research on this wick here. Because I think it's really important to understand this wick was all of a few hours. So this wasn't necessarily because this is the weekly chart. This wick in particular, this was a few hours and got bought up extremely quick. So sometimes I almost like in my head don't see it because I know that few hour time span was not like 3 or 4 days or even 5 days. It was a really quick point in time, which most wicks that are this long are just like that. And so, but nonetheless, this 250 has served as a good level here for getting those really extensive max pain type scenarios. And we'll see, right? So if we kind of look at this, where we've been straddling is in between these levels here, but in between the 200 week moving average and the 250. And so that's actually pretty interesting to me because this just reminds me a lot of kind of like, if you kind of look at some on-chain data, and I know that we do that here as well on the channel. And I like explaining exactly what this stuff means to the best of my ability so that we all can understand. But a lot of what we're seeing is like there's a delta price and a realized price. And so same thing is through time is we're kind of seeing this is kind of representing that realized price almost kind of with the 200-day moving average and this delta price down here with this 250. And so the on-chain metrics kind of line up with what these moving averages are doing as well. So just another little tidbit there. But yeah, that's kind of what we're looking at. and the macro is still bearish. And so obviously with everything with the economy, a lot of the stuff going on, still looking pretty bearish as well. So, it is what it is. All right, cool. So coming up here, I mean, we're ready to go. We're ready for them to start talking, giving us some information. Um, I got some keywords that I'm looking for. I'm kind of curious to know what you guys are looking for as well. So we got about 10 minutes, give or take. So it's going to be a good one. Alts are holding up well for a bear market. I agree. I agree. Well, I'll say this. They are coming back with these rallies pretty well. But if you look at it, a lot of these alts are crushed compared to their all-time high. I mean, even some of these larger ecosystem coins are down like 90%. So if you're looking at it from an investment standpoint, if you were a buyer of a top, that's not so great. But just anything that comes down 90%, that's a severe suppression. But nonetheless, I like measuring things from bottom up. So I think a lot of times we get stuck in that, okay, I need to measure everything from top to bottom. And you're just looking, that just forces you to look at immediate time of that downtrend without looking at all of that uptrend beforehand. Right. And so what we know for a lot of these altcoins, they have exacerbated, extreme uptrends. And we're not talking about, 5 or 6x. We're talking about 20, 30, 50, 100x in some cases. Right. So, yeah, I mean, I just see this opportunity, guys. Like anything that is a good asset that's on 80, 90% discount, accumulation, right? Accumulation is the name of the game. And the biggest thing that has really helped me through time, through the years, right, is to start to understand, like, when it comes to accumulating a volatile asset that we know is go up and down in dollar terms, right? Learn to stop thinking in dollar terms and start thinking about, okay, how many coins do I have? And maybe set some goals to the amount of coins that you're looking to get before this next bull run versus trying to say, how much money can I make? That actually helps out a lot when it comes to the mindset that I think is very helpful to have, especially within crypto. Da-da-da-da. And so a couple of words that I know that we're going to hear words like robust labor markets and, growing economy, which, I mean, they've been saying this stuff, but what we've been seeing, GDP is looking like it's still pretty bad. And I don't know if you guys are keeping tabs, but, there's been a lot of talk of them actually trying to change the definition to what GDP is. And so gross domestic product. And so for the United States for a long time, I mean, for a good portion or maybe all of my investment history, what I've known the definition to be is 2 consecutive quarters of negative GDP growth, year over year, right? So, um, you know, everyone's used that. Economists, I mean, for the longest time, people have used this as like, okay, this is how you define a recession, and they're trying to switch it up. Janet Yellen trying to say, no, that's not the definition. That's not the definition. Now it's based upon, a whole bunch of other stuff that they kind of handpick and cherry pick just because they know that these are still doing decently okay, but they're ignoring all of the other stuff that's just going completely horrible, right? And this is, what we tend to see overall in politics, not just now, but for a very long time, right? So, we'll see here. We will see. But yeah, I'm excited to kind of see, the markets really going on from, I would say, at the end of this week, seeing kind of what happens the next couple of days after this meeting, and then really start to set a plan for, okay, the month of August, because I think there may be some things that are going to be different compared to what we've seen in the recent times here, as far as like how markets are moving, because investors are really, and I'm talking about these are the larger players, they're really, really starting to get better at pricing these things in. Like they really are. And then so we're starting to see people kind of come back on into risk on assets. And that's actually, we'll see. I think that may be a thing that is kind of healthy, and we'll see if it can sustain itself, right? Okay. So Bishop is saying that they may have just confirmed the rate. Okay. We'll see. We want to hear from the horse's mouth as well before we start, making some moves here. And so, I got some alts that I'm accumulating as well. And so, yeah, it's just one of those things is just understanding real value. And so real value, what does that look like to me? BTC under 25K to me, in my opinion, or just really under that realized price, which is like 22, 23K, that's real value. Ethereum above 1500, that's real value, right? And then, like I said, a lot of these main ecosystem coins that, product market fit. There is actually something that you can do when you say, okay, hey, this coin is here, the value proposition. Can I actually go onto its blockchain, so to speak? Or when I go into the DApp, is it doing something? Is it providing some type of yield? Or is it something more than just people saying, hey, this is going to the moon? And then being able to look at the code, right? And then so that's something that I've actually been spending more time in the past month, learning how to read certain parts of Solidity, right? A lot of these coins on the Ethereum network or coins that are EVMs, learning how to use this coding language and look at it. And I've got a couple of friends that, they speak this language. So I'm like, hey, how do I know if this project has admin keys? Are there certain, things in the code that I can see? And there is. And so that's the thing. If you know how to look at these things, very helpful, because as we've been able to see, third party risk, right? So that risk that you have when you give your coins away and you're trying to get some type of yield or anything like that, as we've seen, that's been, it's just been a thing that is not crypto. Essentially, crypto was built and meant for people to have control over their finance. So the moment that you give it away to a custodian, whether it's decentralized or not, or centralized, just know that there is some risk involved. And so you have to be okay with that risk. But if you don't understand that risk, that's on you, right? So my thing is like kind of helping people understand and just really educate themselves on how to mitigate that risk. And if you are going to take that punt, do it with a portion of your portfolio that you're okay with, right? And so, I think it's really important to kind of talk about those things there. So, yeah, BTC. Obviously, since we've been talking, it's uptrending here, so that's going to be an interesting thing to see. Okay, we're going back. Still nothing yet. It's all good. So, they may be late. They may be doing the typical YouTube 5-minute late type thing here. So we'll see how that goes. Do y'all have any questions in the chat? Anything that y'all want to talk about? Anything that is on your mind outside of this meeting? Because I really want to dive into that. I don't want to just be up here rambling this whole time. I can, if y'all want to listen to me just ramble, but I do want to kind of hear what you guys have to say or kind of what some of your guys are thinking, kind of coming up maybe with this next month or two or stuff like that. Okay. So let's just get into it. Let's talk about it. So Hex DCA schedule you're going to use. And so for me, it's just one of those things is, since for me personally, I am a long-term Hex investor. So personally, I'm not the type to say, okay, I think prices may be going down a little bit. I'm going to pull maybe half my bag and try to reinvest it back down to when Hex goes to, who knows, maybe 2 cent, 3 cent. But the thing is, that may not happen. There's a lot of ifs and mays and maybes. My thing is, with things I know that I'm long term on, I just know the difference between 3 cents, 4 cents, and 2 cents in the long term, right? When Hex is, who knows, right? Not giving you guys price predictions, but when it is, $1.50 or $3 or $4, whatever it may be, I don't know. As long as the protocol continues to do what it does, right? It's a complete product. And that's the thing. It's not something that's in development or the blockchain is trying to figure things out. It's a complete product and it does what it's supposed to do. And now whether how people value that product, that's on the market. But through time, so for me to answer your question, I've done some accumulation here above below 5 cents. And then so for me, I have already done my DCA for this month, and I was really able to capture that price period where Hex was straddling in between like 3.5 cents and stuff like that. I did a nice DCA then. And then so for me, like I said, I don't go too crazy when I'm nibbling at the market, but nonetheless, I'm accumulating coins that I know I want to hold long term. And so as I kind of look at my own personal portfolio, so without doxing my portfolio, I'm not going to be purchasing when things start to go up a lot higher, whatever the case may be. My DCA will probably stop because my cost basis, I don't want that to get higher, right? I have a pretty nice cost basis on Hex now, through my time of DCA into it, so I want to keep that low. So that's a little bit to answer your question. And then okay, what are your DCA strategies, timeframes for Hex? So timeframes, man, is hard to do. I really don't like giving timeframes because, you know, my thing is, I like I said, I know that I'm in this game for years, right? And then so whatever that may look like. Now, I would say, and this is a little bit of theory here, with post chain coming out, who knows? But I'd like to say it would be nice if it would come out within these next 2 quarters, either Q3 or Q4. I know some of that goal was to try to beat Ethereum with the merge, which they're saying September potentially, but we know that seems like a moving goalpost. I think this year may be a great opportunity to get some type of a pump from Hex because of that correlation to what it has for post chain, and the whole mantra behind that is like, hey, to get your coins on the other side, you want to try to fill your bag up before post chain is announced and all that kind of stuff. And so we'll see if that happens, right? But I would say, like, as far as like DCA strategies, is like I said, I'm nibbling at the market because I don't know that a low has formed. Now we'll see as kind of time goes on, because there's time, guys. Like, the biggest thing is, I don't think that there's a necessary rush to try to throw in a crazy amount of money into any asset right now, because we know that we are in a very complex environment. I would say this is more complex than other bear markets, to be honest. And then so since this complexity is what it is, and there's a lot of things going on the supply side of things, right? Across the world, this isn't just affecting the United States, but just across the world, things from the supply side are still pretty dire. Um, that just means that we're just not in a growth type of environment. And then so if we're not in a growth type environment, assets kind of go along with that. And so, we're gonna see some things kind of just settle. And who knows, it may settle for 3 months, 6 months. But my thing is, I want that to elapse, right? And I want to nibble at the market. And then when I start to see, okay, things starting to look different on the macro side, I may start to go a little bit heavier. And then so that's me personally. But like I said, I'm accumulating the stuff that I want. And so and that's going to be up to each individual person to decide what they want to do on that front. My guy Navin, cool, man. Well, I hope everything is well. Catch us on the replay. Like I said, guys, if you guys haven't already, I appreciate if you like and subscribe to the channel. Really try to get this out there because I'm just trying to give another view compared to kind of what a lot of people here on YouTube are doing. So I like, kind of like, for me, I like to cite my sources, right? So whatever I'm using, I'm gonna tell you guys. Whatever I'm looking at, I'm gonna give you guys the exact links, and you guys can go and do the research yourself, right? So you can compare and contrast to what I'm saying. And so yeah. Let's see here. Let me check back. Okay, we are live, guys. So let's go. I'm gonna share my screen. Let me know if you guys can hear this audio as well. So he's live, and then see what Mr. J Powell has to say.
Has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
That's key right there. Look at what he's saying.
To bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Let's go. Pepper them with hard questions.
From Washington Post. Wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
That's a good question.
So I guess I'd start by saying we've been saying we will move expeditiously to get to the range of neutral. And I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? we'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Timorous of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, of course we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation is coming higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit higher than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings. and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Hi, Jira. Thanks for taking our question. Gina Smile with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we're not going to be in a recession. So I have two questions.
That's a lie.
The president's confidence in not being in a recession. And second, how would or would not a recession change policy? Isn't a bright line, sir, where contraction of the economy would be a turning point in policy? Or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect. And we think that they're.
He's saying it without saying it. He is saying it without saying it, guys. Softening in labor market conditions, right? They were saying last month that the labor markets were extremely robust.
So we're going to be focused on getting inflation back down, and we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweigh the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you're getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah. We're trying not to make a mistake. Let me put it this way.
He put him in a box with that one.
But there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
Great question.
I do not think the U.S. is currently in a recession.
Ooh, strong words. Strong words.
There are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular.
But you just said we're about to have softening labor market, so it obviously must not be that strong. I mean, come on, guys.
Narrowly high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's just that it's very hard to accumulate U.S. GDP. It's a large economy. And
BTC is pumping right now pretty nicely.
Take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guido with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight. That actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really created a very strong and robust set of rules that will support public trust in the institution. And again, we're just now, the system is just now up and running, and I'm proud of what we did.
Hi, Katarina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for making the decision on how much to raise rates, and just talking about a very large amount that you alluded to. Could that possibly be 100 basis points? And then, kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front end loading these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And in terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris Rugaber, Associated Press. I wanted to ask about right now there's a sort of growing gap between the Fed's preferred measure of inflation, PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we some 20 plus years ago moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in.
He should just ask, do you think that the Fed rate hikes are working?
Economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand. in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is that we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter. That is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Hi, thank you, Chairman. Nicole Dukine, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth?
This is a good question here.
Before it pauses or begins to think about cutting rates.
We want to know
I
specifics.
think you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for insurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the employment compensation index.
Talk about how all these companies are cutting their workforce. Like, you got to talk about that stuff.
So
Companies are cutting 10 to 20% of their workforce as we speak.
you hear much the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So, executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's...
There we go, blaming COVID for everything again.
Nonetheless, I would say some progress on demand and supply getting back in alignment. So I think we're going to be looking at inflation as well. As I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. And we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding recession. So how close are we to a recession? And then how to forecast the possible recessions from banks and economists? How does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. I think you do see weakening, some slowdown, let's put it that way, in growth.
It sucks that he has to keep giving these cookie cutter answers.
But there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was the
Forecast. How do the bank forecast the possible recessions economies? Does that affect the soft landing?
Yes.
We've since the beginning, I think that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
And thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to full strength, and the markets seem to have accepted it. By all assessments, the market should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. So I guess your second question was getting the process of getting back down to the new equilibrium will take a while, and that time it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we look at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which was a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. we're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Rock from Market Watch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place, got forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we rolled out, plenty of people were saying, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that has materially changed the situation, but I have to admit, I don't think I would do that again. We ultimately, the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly, different in the United States, but anyway.
Well, it does matter because you wouldn't have to hike them so expeditiously with the higher rates because you're late to the party. You could have did it more smoothly if you started earlier.
Repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all this? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like, that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy. 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And so that's really what accounts for the pace at which we moved. And, we did, when inflation changed direction really in October, we've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month. And, we kind of thought we we had the story, probably had the story right. But then I think in October you started to see a range of data that said no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted and here we are.
I'm Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession? And just remind us, what is your definition?
Oh, here we go. Here we go.
The Fed doesn't make a judgment on that. We're focused on the dual mandate.
Come on. Using the same answer for everything else. Give your opinion. It's okay.
That wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and this doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a strong signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Thank you very much, Simon Rabinovich with The Economist. You said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that NIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now.
Ooh, there you go.
Higher than the current rate of 3.6. What's your assessment of NIRU? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the national rate of unemployment will have moved up to some significant extent above.
Ooh, struggling with this answer here.
The reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because that's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for the negative slack we have in the economy with the overtight labor market. So if you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically, if the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
I don't think so. I think it's still going to go up.
Jeff Cox from CNBC.com. Just a question about, I hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or we're heading for one. Economists pretty much the same thing. They're being told by folks like you and the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory.
Just like how they said COVID wasn't an issue at first.
So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
No, all I'd really say is I don't think it's likely that the U.S. economy is in a recession now. And I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. Going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging, and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
Oh, there you go. That's the question.
There are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been able to do that when it's the appropriate thing to do, and this year it clearly is. I would say that.
But doing that runs its risk. There's risk to doing this.
Gratified that, well, that basically markets have been working. They've been orderly. There's been some volatility, but that's only to be expected. For a financial stability perspective, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets, and so you have a pretty, from a financial stability standpoint,
We're gonna have to double check that data because I don't think so.
Now, macroeconomic, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, we think of that as things that might undermine the working of the financial system. So big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to to the grocery store and finding that in many cases their paycheck doesn't cover the food they're accustomed to buying. We're seeing actual real declines in food consumption, and it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle? In the fight against inflation, as they try to translate what Fed policy means to them in this complicated economic landscape? Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is.
So I don't know, what's worse, losing your job or just paying a little bit more for prices and goods? I don't know. I think most people would pick the job. They'd rather have a job.
Those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job. It is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth.
You mean casualties? Job casualties?
We don't want to. We don't want this to be bigger than it needs to be. But ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
All right, so that's it. I got a couple notes here. We can recap. That was pretty interesting. A lot of the same framing in regards to the answers that he was giving across all the different questions, but it all kind of centralizes around them trying to get to their mandate of 2% inflation and trying to attack it. So a couple notes, right? And just kind of, for those that might have missed it or just kind of tuned in. So where we're at currently now, the Fed fund rate is 2.25% to 2.5%. And so that was a 74 5 point basis hike and a little bit different language here. And then so they're finally admitting that we're having some softening in the labor market. So before they're using words like, hey, we have an extremely strong or robust labor market. Now they're acknowledging that, okay, hey, people are they're starting to lose their job here. So that is a concern. And they're trying to say, okay, well, we don't want it to be bad, but the other part to that is, but if it's what we got to do, then so be it. And that's kind of, the sentiment of kind of like how they're saying that. And then so, what we're knowing is to this date is their goal is to try to get to 3.25% to 3.5%. And so the thing is, we would technically have, what does that say? So there's September, November, December, 3 more meetings, right? And so with us already being at 2.5%, another 75 basis point will pretty much get us there. Now, if we kind of look at the things that we have this time, right? So we look at the time that we have until September. So allow more data to come in. We're going to see, and I think the markets are going to really appreciate if we come off of the 75 basis points and we maybe go down to 50 or 25. And after hearing that, that kind of sounds like that's kind of where they're going, and they just can't say that, right? So it's interesting. And then so another different sentiment that I kind of got to read on is them kind of using words like this or Jerome Powell using words like, hey, they want the policy to be moderatively restrictive. And so instead of saying, hey, we're trying to tighten things and really beat down the demand, they're lightening up and say, hey, we just want them to be moderately restrictive. So I'm noticing just some change in his rhetoric. It's pretty interesting to kind of see that. But as you can see, he's changing, or really just trying to do his best to stay as neutral as possible without giving any of his own personal opinion, which that's his job. But I think that they're gonna keep doing what their plan is to just kind of kill the demand, but mainly try to get people to have a sentiment of like, hey, things are hard, right? They're not really talking about ways to make things better besides the interest rate going up, which I think there can be a better, I guess you could say, he could speak a little bit more candidly. In my personal opinion, he could speak a little bit more candidly on some other aspects. I get that that's his job, but without being too influential, I just think that, that's just kind of what we have here. So interesting thing. So as of right now, I mean, yeah, I think you hit it around the head. He escapes again. That's just kind of what it is for now. But I think we're going to have an interesting rest of this week. So I'm going to be having my eyes out and looking at certain things. I think that through time, we're going to start to see this stuff to really show itself as far as the story of how, the markets will move. Let's see. Let's kind of jump into Bitcoin one last time and see where things are at. So things definitely pumped up a little bit through that meeting. And so that was, interesting to see. So let's kind of get back to that daily chart. And so we got a big, big, big green candle coming back. And so, that is definitely a trend change from, the past 1, 2, 3, 4, 5. So from this past week, this is a big change. And so we're having a big candle here. Let's see if that continuation can continue. So like I was saying, okay, we've already eclipsed this 22,000 range and we're tapping on the door for 23,000. Now we want to see, like I mentioned before, if we can get above, right, this 60-day EMA here. And so, that's going to be 23 and some change. If we could sustain it and use that support, I think that'll be some positivity for the markets to say, hey, things can look pretty good from here. And like I mentioned before, we do have a confirmation with the algo. And so, that's just kind of the story on that. And so as we continue to watch this, as we continue to see the next level, right? So if we break past these areas here, especially that 23,000, that 23.5, the next level And so I'm going to kind of pop this up on here. The next level that we want to kind of be looking at is boom. So like I kind of have this labeled as this is like that medium demand range. So if we can kind of even pull this over, there's been this medium amount of demand, so this mid demand range, and we've kind of popped our head above it. Now the question is, can we get to this next level right here? And then so this will kind of serve as resistance. So I'll put a price call here. And so this next level of resistance, if we can break through this area, it looks like it may be some clear skies to this about 27, almost 28K range. And so that's the next batch of where the liquidity kind of sits, where Bitcoin has exchanged hands, where people came in the market right here. And so, that could lead to a nice little, gain here for BTC, about a 20% gain. So that's on the table. Not saying that is going to happen, but it's on the table, right? And so, this is kind of something that I would say would bring some life back, nonetheless, to the crypto market. And so, if BTC does that, let's go ahead and look at Ethereum while we're here, and then we'll wrap up. So, if BTC is looking to potentially have a nice gain, the thing is, Ethereum is definitely much more extended. And so it's already, I would say Ethereum is kind of outpacing above BTC, because if you look at it, Ethereum is already above its 60-day, moving average. And then what did it do? It came down and used it as support right here, and then it's back off to the race. So the thing is, if Ethereum can get above this level here, so let's kind of make this a little bit easier to see. So if Ethereum can get above this level here, right around like 1644, so let's call it 1650. If we can get above that and sustain it, we could potentially come up and see that 18 to $1,900 Ethereum, right? And I think that would also be something that will get a little bit of excitement going on in the market. And who knows, when people kind of be like, oh, things are happening, right? This kind of brings maybe the short-term buyers back, because as we know, the short-term buyers have, for the most part, they've left the market. And so we'll see if that can perpetuate into a larger rally. But nonetheless, the rally that we've had to this point has been pretty impressive. I mean, if you want to take this low, so here, let's kind of exit out of that. We'll clean this up a little bit so we can see it. So if we want to take this low where we were, and this is in June, so if we were to take this low to where we are today, there's been an 80% gain on Ethereum, and that's if you were able to snipe those lows. Haha, I sniped those lows a little bit myself. Hope you guys did too. If not, then maybe catch the next one, if there is a next one. But nonetheless, with that being said, what we can kind of do is do a small little projection here and say, okay, well, let's say for the medium term, and so I'm talking about within the next week. Let's say this is the bottom here for the next week. So this is kind of like that little bit of a low right here at 1368. What we can do is we can invert the fib retracement, come from top to bottom. And then so these price levels coming up here are something that we might be able to see as a capability, right? So if we kind of draw a few lines here. So like I said, around that $1,800 Ethereum, right? There's a batch of liquidity here, as we can see. And then going up here possibly to this 2.6 level for the fib retracement. And then if things get incredibly bullish on this rally coming here, and then what does that do? And then so this level would be interesting to see if that were to happen. So this is that 200-day moving average, and as we can see, it served that as well with the 250. It served as somewhat of a resistance. So we may get attracted back up to it. So we may melt up to it, right? And then so as we can kind of like draw this out, we kind of see this kind of coming out, and as if price comes a little higher, kind of see it settling. And we'll see if we can kind of come back up to it. And that would be maybe one of the first steps to saying, okay, hey, there might be something a little bit more than a rally coming. But that would be the first step, and we'd need more confirmations to say, okay, there's a bottom end. This wouldn't be just it. And like I said, with the macro going on, I don't know if I'm convinced of that. But for me, I'm just going to let the data come through and let the story prove itself. and be able to react with my plan. And so, yeah, like I said, I encourage everybody to have a plan. But if you can see, look at this volume profile, right? An area that is going to be a little bit tougher is, if you can see how we have this ledge here, the area that's going to be a little bit tougher for us to break through, right, is coming up here, is that $1,900 Ethereum. So I'll do 2 price calls here, right? So that way we can have an idea of, what, price may do if, and there's a big if we can have a sustained rally coming up here. And then, yeah, so that's kind of what we're looking at for this medium term. And so that means, within the next week or two. And yeah, and then that would essentially start to come up on, like I said, because we're going to have this trend line here. And if we could break that trend line, then I would say we would potentially see a sustained trend reversal. And then so let's kind of make that a little bit easier to see. So there's a lot of ifs, right? So if this, then, but nonetheless, there isn't a nice uptrend, and there was a lot of sentiment change, and we can see that in today's candle. So I'll leave it there. Until next time, I'll try to do a stream here coming up probably this weekend, guys. Try to do another stream this weekend. And I really appreciate y'all coming in, tuning in. I think that was a great little session, little TA session, but also we got a chance to get a good sentiment read on what's going on with the Fed. And so yeah, for me personally, I'm still accumulating. And for me, I just know that the people who have a plan, one, who are willing to go through these tough times within this bear market, and people who have a long time preference, so more than 2 to 3 years, you're going to do great. And I can't guarantee what your returns will look like, but I know if you stay in this crypto game and you continue to DCA, especially with these huge discounts, but mainly picking the right stuff, right? So being able to do the research on some projects, and be able to not basically spread yourself too thin. So don't go and try to basically cherry pick, 13 or 50 or 20 different projects. And so I did a whole bunch of random numbers, really try to consolidate on coins that you want to accumulate a lot of, that you really believe in for that time preference, like how we mentioned, long period of time. So I know, I have my batch of about 7 coins of that I'm just continuing to accumulate, and then even tighter, maybe about 3 or 4 coins that I'm really, really just trying to, accumulate a good portion of, since I know that we have such a good discount. And so, yeah, that's it. I could give you guys a little bit of insight on this. So, I don't want to sway you guys in any way, shape, or form. I really want to be a neutral source of information. But I kind of mentioned before, Hex is a coin that I am accumulating, Ethereum, and there's some other projects as well. Phantom is another coin that has been on my radar for some time. I've had a lot of success with Phantom, and I was able to really capture those high profits that came in when Phantom was at about $3 and some change. And so I was able to cash a lot of that out, and so I'm redistributing that capital back in and grabbing some more coins on discount. And then among some other coins, I got another couple coins that are a little bit of a smaller cap, but do I want to say it? Why not? So coins like Lux Rare is a coin that I have found to be very interesting. Rune, and that's it. I'm not going to give you guys too many, but do your own research, guys. Do your own research. But kind of gave you a couple of things that I'm looking at. So with that being said, I appreciate y'all for sticking along, and I think that we have some interesting times coming up. And just to let you know, so the rest of this week, we got some more earnings on the stock side. So this is kind of how I see the rest of this week playing out. If we can get some decent earnings, or maybe good earnings for Apple and Amazon, basically anything that's not horrible, we may have an opportunity to have a decent week this following week. And so, yeah, we'll continue to read that sentiment. And I'm hoping that you guys were investing when we had that capitulation. But if you haven't, if you feel like this may be a time to where you want to just nibble at the market, I'm not going to discourage anybody from doing that, but obviously have a plan, and hopefully you guys choose wisely. So with that being said, I appreciate you guys. And one last time, if you haven't, subscribe to the channel. Looking forward to you guys, kind of tuning in on the next stream. Until then, peace.